Hello and welcome. Have you ever really thought about what happens to your money after you deposit it into a bank? You might picture it sitting safely inside a giant metal vault, just waiting for you. But the truth is so much more fascinating. The moment you deposit your money, it enters a complex financial system that quietly powers almost everything around us, from your morning coffee shop to giant corporations and even entire countries. So today, let's pull back the curtain and uncover what really happens to your money, how banks operate behind the scenes, and the massive role they play in shaping the world we live in. When you deposit your paycheck, let's say $1,000, into your bank account, you feel secure seeing that number pop up on your phone. But here's the first surprise. Your bank doesn't actually keep all of it. In most countries, banks operate under a rule called the reserve requirement. This means they only have to keep a fraction of your deposit as actual cash. If the reserve requirement is 10%, the bank holds on to $100 and can lend out the remaining $900 to someone else. Now, this is where the magic really starts. That $900 doesn't just disappear, the bank lends it out, maybe to a family buying a car, a student paying for college, or an entrepreneur launching a small business. Let's say the borrower is Sarah, who uses that $900 for a new car. The bank charges her interest on that loan, maybe around 7% per year. Meanwhile, your savings account might be earning you just 1% interest. The difference between what the bank earns from Sarah and what it pays you is called the net interest margin, and that's one of the main ways banks make a profit. It might sound small, but when you're talking about billions or even trillions of dollars, it adds up to huge profits. Globally, the average net interest margin for banks is about 3%. That doesn't sound like a lot, does it? But when a single large bank is handling hundreds of billions of dollars, that 3% can turn into billions in profit every single year. But the story doesn't end there. In fact, it gets even more interesting. The $900 Sarah used to buy her car doesn't vanish. The car dealership that receives the money will deposit that same $900 into their own bank account. Now, that bank keeps 10% in reserve, which is $90, and lends out the remaining $810 to someone else, maybe to help a new business owner open a shop. That $810 is then spent, deposited again, and lent out again. Through this chain reaction, your original $1,000 deposit can actually create up to $10,000 of new money circulating in the economy. This process is called the money multiplier effect, and it's one of the most powerful forces in modern finance. Banks don't just store money, they create credit, multiplying the flow of cash that fuels growth and opportunity. In many ways, banks are the beating heart of the economy. Without them, most people couldn't buy homes, cars, or even go to college. Businesses couldn't expand, and governments would struggle to finance public projects. In 2023 alone, small businesses in the U.S. applied for over $60 billion in loans. And globally, total household debt has surpassed $57 trillion. That's how deeply banking touches our everyday lives. It silently moves the gears of the economy, connecting savers and borrowers in one massive system of trust and exchange. But this system is also fragile. What happens if too many borrowers, like Sarah, can't pay back their loans? That's exactly what happened during the 2008 financial crisis. Banks had lent out enormous amounts of money, especially through risky home loans. When people started defaulting, banks lost billions. And because the financial system is so interconnected, one bank's failure spread like falling dominoes across the entire world. It wasn't just a few banks that suffered. The whole global economy slowed down. Millions lost jobs, homes, and savings. That event showed just how powerful and dangerous the modern banking system can be when trust breaks down. To prevent disasters like that from happening again, central banks and governments regulate the banking system heavily. They require banks to maintain capital requirements, which means they must keep a certain amount of their own money as a safety cushion in case loans go bad. They also run stress tests, simulating economic crises to see if banks can survive them. These safety nets are meant to protect not just the banks, but also depositors like you, so your savings remain safe even if the financial system gets a little shaky. But banks do far more than just hold deposits and issue loans. The biggest banks in the world are actually massive corporations with many different divisions. They have investment banking arms that help companies raise money by selling shares or bonds. They organize mergers and acquisitions, helping one company buy another. They also have wealth management divisions that advise wealthy clients on where to invest their money. And let's not forget the trading desks, where banks buy and sell currencies, stocks, and commodities to earn profits for themselves. In fact, the top 4 U.S. banks, JP Chase, Bank of America, Citigroup, and Wells Fargo, generated over $500 billion in total revenue in 2023 alone. That's more than the entire GDP of some countries. Now, let's bring all of this back to you, because this system directly affects your financial life. When you deposit money, take out a loan, or even swipe your credit card, you are an active participant in this massive system. The interest rate on your savings account, the rate on your mortgage, and even the price of the goods you buy are all influenced by how banks operate. For example, when central banks like the Federal Reserve raise interest rates to fight inflation, banks quickly increase the rates they charge on loans and credit cards. But do they raise the interest they pay you on your savings just as fast? Usually not. This gap increases their profit margins. That's why being financially informed is so important. It empowers you to shop around for high-yield savings accounts, refinance loans at better rates, and understand how interest rate changes affect your daily life. The truth is, banks don't just hold your money. They manage the flow of wealth that runs through our entire society. They are, at their core, institutions built on trust. You trust them to keep your money safe. They trust borrowers to repay what they owe. And the government trusts banks to handle this responsibility with care. When that trust is maintained, the system thrives. When it breaks, chaos follows. So next time you open your banking app, make a transfer, or see your paycheck arrive, take a moment to think about what's actually happening behind that screen. Your money isn't just sitting idle. It's part of an intricate dance of risk, reward, and trust that powers businesses, builds homes, and drives innovation across the globe. Understanding how banks work isn't just about knowing where your money goes, and it's about understanding how the world financial heartbeat functions. It's about seeing the connection between your small deposit and the vast network of loans, investments, and credit that keeps our economy alive. Thanks for watching. If you found this explanation helpful, make sure to hit that like button, subscribe us, and let us know in the comments what topic you want us to explore next. And remember, stay educated with us.